Arista Networks just dropped an earnings report that didn't just beat Wall Street's expectations, it took a sledgehammer to them. Now, this isn't just some tech company having a good quarter. No, this is the sound of the forge, the blast furnace, where the literal backbone of the entire AI revolution is being built. And tonight, we're going to find out if it's really built to last. Welcome to Iron Financial, where we help you forge a stronger portfolio and cut right through that market weakness. Whoa, hang on a second. A forge? A backbone? Let's pump the brakes. The numbers are impressive, I'll grant you that. But the valuation is, well, it's astronomical. We're talking about a stock that is priced for absolute flawless perfection, and then some. So the real question we have to ask tonight is, are they actually forging an empire? Or are they building this beautiful, intricate house of cards on a foundation of pure hype? We're here to stress test the entire structure, to really see if it can handle the pressure. And that is exactly the plan. We're running what we call a forge test. We're going to take every single component of Arista's financials and subject it to some intense heat and pressure. First, we'll examine the raw materials. We're talking record-breaking revenues. Then, we'll apply a pressure test to their profitability and look for any cracks. After that, we'll analyze the blueprint for their AI backbone. We'll test the very foundation of their fortress-like balance sheet. And then finally, we'll give you our verdict. Is this company forged from solid iron, or is it just a shiny piece of chrome? Let's fire up to forge. All right, first things first. Before you can build anything strong, anything that's going to last, you need a solid blueprint, and you need high-quality raw materials. For a company like Arista, that raw material is revenue. Pure, unadulterated top-line growth. This is the foundation that everything else gets built on, so we have to see just how strong it really is. So let's start with the first hammer blow of data. For the fourth quarter of 2025, Arista pulled in nearly $2.5 billion. Now, to put that in perspective for you, the consensus on Wall Street, the so-called experts, they were looking for about $2.39 billion. Arista didn't just step over that bar, they pole vaulted over it by a cool $100 million. That's not a beat, that's a statement. But listen, it's not just the size of the beat that's impressive, it's the velocity. That $2.5 billion, that represents a nearly 29% increase from the exact same quarter last year. In this economic environment, with so much uncertainty out there, for a company to deliver almost 30% growth at this kind of scale, well, they're just operating on a different level. This is the kind of momentum you see from a runaway freight train. And this right here, this just illustrates the sheer scale of this operation. For the entire year of 2025, Arista hauled in $9 billion in revenue. That is a monumental milestone for this company. It absolutely solidifies their position not as some up-and-comer, but as an established titan in the networking space. This isn't a plan on a whiteboard anymore. This is a fully constructed, revenue-generating machine. Now let's look at the full scorecard, because this is where the story gets even stronger. First up, adjusted earnings per share. They delivered 82 cents, absolutely smashing the 76-cent estimate. That's a clear beat. Next, revenue. We just covered that, a massive beat of $100 million. But here's the crucial point, the thing you have to look at, their guidance for the next quarter. They're guiding for $2.6 billion, well above the $2.46 billion the street was even hoping for. This tells us they aren't just looking in the rearview mirror, they are pressing the accelerator hard. And hey, don't just take my word for it. The CEO, Jayshree Ullal, she called 2025 the year of validation. They shipped a cumulative 150 million ports. Think about that. This wasn't some fluke, it wasn't a lucky quarter. This was the successful execution of a deliberate, multi-year strategy. They built the foundation, and now they are scaling the skyscraper. The top-line structure is solid iron, no question about it. All right. The revenue story is strong. I'll concede that. The foundation looks solid. But a skyscraper is only as strong as the materials that are used on every single floor. And rapid growth, well, it often comes at a steep cost. And that's where things can get really dangerous. So I think it's time we put this structure under some serious pressure and check for any cracks in the profitability. This is the question that every single investor out there should be asking. You can sell dollars for 90 cents all day long and show some absolutely incredible revenue growth. So is this explosive growth actually profitable, or are they just sacrificing their margins, the structural integrity of their profits, to post bigger and bigger numbers on that top line? Let's find out. And there it is, the first potential crack in the armor. Look at this chart. In the third quarter, their GAAP gross margin was a pretty healthy 64.6%. But then look at the fourth quarter. It dropped to 62.9%. That's a significant sequential decline.
But what's more important, look at their own guidance for the next quarter. They are telling us to expect margins between 62 and 63%. The trend is clearly down. This, my friends, is called margin compression, and it is a big warning sign that the cost of doing business is on the rise.
Okay, that's a fair point, and it's exactly why at Iron Financial we do the heavy lifting. Before we go any further, it is absolutely critical to understand the difference between GAAP and non-GAAP. Think of GAAP, that's generally accepted accounting principles. Think of it as the official, standardized blueprint for a company's financials. It's the rule book. Non-GAAP numbers, on the other hand, well, they're adjusted by the company. They often exclude things like stock-based compensation. Now, they can be useful, but they can also be used to paint a rosier picture. You have to look at both to see the real truth. And this is exactly why context is everything. Yes, the margin percentage did compress slightly. I see that. But look at the absolute dollars that are flowing to the bottom line. On a GAAP basis, their net income was still up over 19% year over year to nearly $1 billion. And on a non-GAAP basis, it was up over 23%, crossing the $1 billion mark for the quarter. So the crucial point is this. Even with slightly lower margins, their operating leverage is so incredibly powerful, meaning as the revenue grows, their profits grow even faster, that they are generating enormous profit growth. The structure is flexing under pressure. It's not cracking. Okay, so the profitability is holding up under pressure. We've established the foundation is strong, and the structure can absolutely handle the load. So now we need to talk about the why. Why is Wall Street willing to pay such a massive premium for this stock? It all comes down to one thing: its central role in building the AI backbone. This is the hype engine, and we need to see if it's got real horsepower. And this right here is their blueprint for total dominance. They set a goal of over $1.5 billion in AI-related revenue for 2025, which they exceeded, by the way. But look at the target for 2026, $2.75 billion. That implies a year-over-year growth of around 80% in their most important segment. This isn't just growth. This is a land grab. They are positioning themselves as the essential, non-negotiable plumbing for every single major AI data center that's being built. AI models, you see, they require these massive east-west traffic patterns inside the data center, and that happens to be a specialty of Arista's architecture. That's their edge. But hold on, they're not building this empire in a vacuum. You cannot ignore the 800-pound gorilla in the room, Cisco. We're talking about a legacy giant with deep enterprise relationships and an absolute army of salespeople. Just recently, Cisco announced they had secured $2.1 billion in AI infrastructure orders. That's not just a warning shot, that's a direct hit. It proves the market is massive, sure, but it also proves that Arista's days of having this playground all to themselves are over. The competition is here, it's real, and it is incredibly well funded. That's a valid threat, no doubt about it. And any potential weakness from competition makes the underlying financial strength of the company even more critical. So before we deliver our final verdict, we have to inspect the foundation one last time. We're talking about the balance sheet. Is this company built on solid bedrock, or is it leveraged on a pile of debt? And this slide right here perfectly illustrates the discipline of this management team. This diagram lays out their entire approach to capital. They take the cash generated from operations, about $3.1 billion in just the first 9 months, and they put it to work intelligently. They maintain a healthy balance sheet, they invest it back into the business, and they return a significant amount of capital to their shareholders. I mean, look at that, almost $1 billion in share repurchases. That's a sign of a management team that is supremely confident in its own stock. And if you want just one single number to represent the sheer financial power of this company, this is it. $4.372 billion. That was their free cash flow. This is the pure, unadulterated cash that the business generates after all expenses and investments are paid. It is the lifeblood of a company, and Arista is pumping it out at an absolutely incredible rate. This is what you use to fund growth, fight off competitors, and reward shareholders. Okay, you have to give it to them here. I mean, there's just no arguing with these numbers. They're sitting on nearly $2 billion in cash and almost $9 billion in marketable securities. That's over $10.7 billion in liquid assets. And they have virtually no debt. This isn't just a strong balance sheet, it's a fortress. This financial strength gives them a massive moat, a powerful defense against any market downturn or competitive pressure from the likes of Cisco. The foundation is solid rock, period. All right, the Forge test is complete. We've examined the revenue blueprint, we've pressure tested the profitability, we've analyzed the AI growth engine, and we've confirmed the foundation is an absolute fortress. So it's time to pull Arista out of the fire, let it cool down, and deliver our verdict. Is this company forged from solid iron, or is it just a piece of cheap, shiny chrome? The bull case is clear and it's powerful. Arista is a dominant, best-in-class player in this single most important tech trend of our generation, AI networking. They're delivering explosive, estimate-crushing revenue growth quarter after quarter after quarter, and it's all built on a fortress balance sheet with massive, undeniable cash flow. But the bear case is just as compelling. I mean, the valuation is simply eye-watering. A trailing PE ratio of 53 times earnings means you are paying for years of perfect execution in advance. There are clear, undeniable signs of gross margin pressure. And the competition from a titan like Cisco, it's no longer a future threat. It is here, right now, and it is intensifying. So here it is, the final verdict from Iron Financial. Arista Networks is not chrome. It is not a fake. This company is forged from high-grade, high-tensile steel. The fundamentals are incredibly strong, the execution is superb, and its market position is enviable. The problem is, the market knows this, and it has priced this company not like steel, but like some rare, indestructible titanium. The quality of the asset is undeniable, but the price reflects a future with zero mistakes, zero competitive losses, and zero economic headwinds. And that leaves you with the ultimate question. We've done the stress test. The structure is fundamentally solid. It's built to last, but the price of admission is incredibly high. So for your portfolio, you have to ask yourself, if you're a long-term investor who's betting on the AI revolution, is paying this kind of premium for best-in-class strength worth the risk? Or if you're a bit more value-conscious, does that high price tag represent a potential cliff edge if even one small thing goes wrong? That's the decision you have to make.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.